Good afternoon and welcome to today's ASF and Perpetual Corporate Trust webinar. We are proud to partner with the ASF for the release of this year's research report entitled 2020 Vision, Securitisation in the New Decade. As we manage through COVID, we have all embraced new ways of working and delivering our services with innovation, competition, diversification, and digital transformation as key catalysts driving change in our industry. The Australian securitisation market continues to be resilient and has successfully managed the risks, challenges, and funding through the COVID period with the support from the RBA, AOFM, and ASF. 2020 Vision, Securitisation in the New Decade, will mean many things to many people. For us at Perpetual, we are excited because we're launching a new innovation company, Perpetual Digital, with a bold vision to be the leading digital solutions provider to the banking and financial services industry. Innovation, product development, delivering digital solutions has always been at the core of our business. We listen to the challenges of our clients that they're experiencing and focus on innovation to develop new products to meet the needs of today and tomorrow. We have partnered with Microsoft and Insight to develop new products under our business intelligence cloud platform to support automation of business processes on transitioning to the cloud. Investor portfolio management, credit stress tests, risk management, IFRS 9 reporting. Next month, we launched digital trust management, followed by the funding and pool optimization product. So there's some exciting times ahead for us. Now, what we did this year is we focused on the rise of the new non-bank lenders, fintechs, diversification, and innovation, and how these forces may impact the shape of our industry. We are fortunate to have the author of this year's report with us here today. Gary Lambert is the Senior Manager, Client Insights and Analytics at Perpetual, who conducted a survey of industry participants to gather their views on innovation and change and what lies ahead for our securitisation industry. Gary will now provide an entertaining overview of the research report and then introduce our panelists for today. We ask that you submit your questions via the ASF event portal during the session, and we will endeavour to address as many as possible. Please note that a recording of this will be distributed after the webinar. Thanks again for joining. We hope you find it interesting and entertaining.
There we go. Hopefully you can all see that and we're ready to rock and roll. So interesting and entertaining. Let's hope that works out for you. I'm sure you'll let me know if it doesn't. So we're talking about the next decade, and it's interesting when you think about the start of the decade, what a start it's been. Before we get too far down the track, what we need to do, of course, is everyone needs a good disclaimer slide, and I thought the Mediterranean was a nice way to do a disclaimer. What it's really saying here is that the opinions that you'll see today are not Perpetual's and not my own. They're the opinions of your respected colleagues right across the industry. And that's what we set out to do with these studies. We go out and we talk to people about issues that are current. The issue for this year was a big one from my point of view. So I've been asking people questions for a living for 30-something years now. And the hardest question to ask people is what's going to happen in the future. Didn't stop us trying though, and there were many, many new and interesting ways of looking at the future, which we shared with participants. Now, the funny thing was most of the interviews were done in January this year. And in January this year, of course, things were very, very different. So you'll see some interesting comments that came through at the start of the year. Because of what happened after January, we figured, well, let's just take stock and come back in the middle of the year. So we came back in August and spoke to a few more participants just to see whether what we'd found at the beginning of the year was likely to be sustained throughout the decade or not. We talked to a very senior audience. There are 6 or 7 CEOs, plenty of C-suite executives and lots of investment professionals in securitisation and a wide range of participants to be reflective of the views of the industry. And they were face-to-face interviews. Let's hope that can continue and they'll come back before very long. One of the things I love about this industry is that when I talk to people in it, I find these unique characteristics. And I've been doing market research for, as I say, 30-something years. And I have dealt with many industries, many different industries, but this securitisation industry is unique in the quality of individuals expressed. And so when we looked at what was happening around the world in February and March and started to wonder whether what people told us in January was going to change, we should have had confidence in the people in the industry to make sure that the foundation of the industry, that's incredibly strong and continues to get better, would help us through any time, whether it's a GFC, whether it's a pandemic, or whether it's anything else. And these are some of the qualities I find in the individuals I talk to. There's plenty of 30-somethings in the securitisation industry, and I don't mean 35 or 36, I mean with 30 plus years of experience. And that's what makes it a great industry. So we started the year and I went out and spoke to people about the new decade, and I asked people to describe what they were feeling about the decade, and I saw words like gangbusters, buoyant, all the signs are pretty positive. And then I spoke to a treasurer from a neobank, and he made the comment on the top right there, and this is end of January. The biggest threat is things like the potential for pandemics to come through and the possible flow-on impacts to the economy. Now, isn't that prescient? Just imagine being able to say that at the end of January. And of course, we thought things might change, but what has really happened? Well, we're going to focus very much, I'm calling this the anti-COVID presentation, because I'm sure you've heard so much about it that you don't want to hear any more about it. So what we're going to talk about is the next 10 years. At the beginning of the year, we found four big themes. It was these four. So an increase in participation was obvious to everybody in the industry. There's diversification of asset classes, the rise of the warehouse. Warehouses have been around for a long time, but there's a nuance of difference with warehouses these days, and the growth in non-bank share of RMBS, which also has been going on for a long time, but continues to grow. So let's have a look at this in just a bit more detail. And I'm going to have a drink of water as I go. That gives you time to read. So an increase in participation, well, it was pretty obvious to people. There were lots of new businesses. There were fintechs, there were neobanks, lots and lots of new entrants into the market, but equally, as much as there are new issuers, of course, not much point in having new issuers without new investors, without warehouses to support their funding, and so on. And I love these couple of quotes at the ASF conference this year. There's a whole bunch of guys in t-shirts, and they weren't serving drinks. Everything is broken open in the securitisation space. The barbarians have stormed the gate and they're in. Now that was said with a smile on the face, and that's also the benefit of a face-to-face interview. So lots of new players, and let's hope that continues. The asset class diversification was a welcome relief to a lot of investors because they'd been asking for it for a long, long time. 4 or 5 years ago, we did our first study of this kind. It was with global investors. And they couldn't quite understand why the Australian market was a bit slow to be offering a wide range of assets as they were used to and familiar with in Europe. But that's all changed this year. It's changed for a number of reasons, but probably the primary one is that investors are calling for it, and as they've got a hunt for yield going on, and they have done for a number of years, and a lot of these new players have seen opportunities to come in and work with asset classes that perhaps have been underserviced in the past and therefore provided opportunity. When it comes to the warehouses have been around for a long time. They play an absolutely critical role in the industry. What have we found so far this year? Well, there's more of them. We've got global warehouses coming in. We've got warehouses playing unique roles with the businesses they engage with. Every warehouse seems to have a nuance of difference in the types of issuers and businesses they're interested in. But the one thing that's been common right throughout the industry is the open door policy. You've never seen so many people knock on the warehouse's door and have that door opened and have a ready ear to hear the story. Of course, as I say, each warehouse has its own preference in terms of the types of issuers they're prepared to fund. But they've all been very, very open. And the other real benefit for the industry in having open warehouses is they provide guidance. And when they're providing guidance, you end up with a greater sense of governance across the industry, as you'll see by that quote down the bottom. When it comes to non-bank RMBS, well, that's been a steady rise over a long period of time. In fact, one or two have said, well, you know, it's always been that way. And in fact, it might be more of a return. There's a lot of talk among fintechs and neobanks in particular about the importance of customer service. And many of them talk about the importance of customer service as though we're hearing it for the first time, but not non-bank lenders. Non-bank lenders have been making it a mantra for many, many years. And having spoken to issuers in the last couple of years and investors in the last couple of years, they're always remarking on the quality of service provided by non-bank lenders particularly. And that quote on the left at the top there says it all: maintaining a transparent, ethical, honest, solid and proper relationship, doing the right things by investors and banks is massively important for a business. Look, it might be, people might say that there's been a gap in the market as banks have pulled back a little bit, and that space has been filled by the non-bank lenders. But frankly, the way they deal with the market and the way they engage with the market, both when a deal is on the table and also in between, means that they're here for the long term and they'll continue to operate that way. Innovation. Well, it's a great word to be able to throw out there, and it's funny, you don't often understand something is an innovation until you see it. And I was just using the word more broadly and generally with participants, and they'd go in one of three directions in terms of what they'd talk about. They'd either talk about technology, they'd talk about product and structure in securitization, or they talk about this trend with consumer-driven innovation, changing the way we're doing business. So let's look at technology first. And the interesting thing when you read between the lines on what people are talking about in the way of technology, it's about the bureaucratic side of things. They comment at the bottom, we don't use black boxes, we don't have a computer that says yes or no, we still have creditor assessors check every loan. However, the difference is there's not paperwork lying all over the place. And so even when people are talking about implementing technology and introducing technology that makes it easier for consumers, a lot of the benefits of technology is in the efficiency that it gives, and in fact, it obviously costs less to deliver the services you're delivering. So a lot of benefits in technology. When it comes to innovation and product structure, I keep recalling one of the new warehouse providers talking to me about esoteric investments and the fact that in Europe in particular, esoteric investments like containers, for example, or maybe even student loans, are the sort of things we don't see a lot of in Australia, but there's been a lot of movement in terms of product and structure, and there's a lot of talk about movement to come. There's a smattering of comments about superannuation funds directly issuing to the public. There is some actual work being done on a multi-issuer style of consolidated trust, with multi-obligators. One of the comments, though, that somebody made about that was it'd be a bit like herding cats, and so they're not sure how that'll go. For years, global investors have said, master trusts, where are they? Why haven't we got them? Well, the buy now, pay later crew making it possible by using that technology. So that's growing. ESG, we did a survey at Perpetual the other day, 3,000 Australians. We asked them, have they heard of ESG investing? And we found 4% of Australians have heard of it. And yet in the financial services industry, it's flavour of the month and continues to be talked about. And in fact, when consumers are passionate about it, it is something that's very important to them. And of course, the range of assets just means diversification. And there are many, many opportunities to put deals together in different ways. So lots of potential innovation in structure. The slide's taking a little bit of a while to move, but it's a nice green one, so why not? And consumer-driven innovation. So there are different schools of thought about whether or not, the human will retain the importance it has into the future. There's one school of thought that says, look, if you make things easy for consumers, make it convenient for consumers, they'll go on and do a FaceTime, they'll use a chat bot, they'll click a few buttons and do anything they can just to get on and get on with their day, rather than sort of go through the process of talking to a person and dealing with potential red tape. On the other end of the spectrum, there are many people in the industry that say, well, if I'm making a very big decision, and a big decision such as getting a home loan and being in debt for that many years, well, I really want to know who I'm talking to, and I really want to talk to a person. So there's two views there, but nevertheless, it's very clear that consumers are adopting online everything these days. In fact, that survey we did with 3,000 Australians, 80-plus-year-olds, something like 40-something% of 80-plus-year-olds surf the internet in their spare time. How about that? That's something I wouldn't have thought. Okay, let's have a look at these fintechs and neobanks. It wasn't all about these guys, but they are prevalent in the industry and they're starting to crop up like mushrooms all over the place. And the first thing I'll point out is the service provider comment in the middle there. The first time they met a fintech, they talked about fintech and they said, oh, stop right there. We use the terms fintech and neobank because it's easy and they've already got some traction. But when you talk to fintechs and neobanks, every single one of them sees themselves as being unique and different. And I guess that's the way it ought to be. Who are these people? They're people that have seen an opportunity. They're just like any business that wants to grow and wants to grow quickly. And within them, there's a lot of people with a lot of experience. What are they trying to do? Well, there's one word for what they're all trying to achieve, and that's scale. It's a scale game. It's all about scale. If you can go through the different stages of funding, and as you go through those different stages of funding and get cheaper sources of funding as you go, that is the ultimate. The truth is the vast majority haven't come to market yet, but many of them have warehouses. They appreciate the work that warehouses are doing with them. And it is helping them achieve that scale. But the other thing that I found was quite important in the attitude of a lot of fintechs and neobanks is a real passion for doing the right thing by the customer. A real belief that people are looking for a better deal and a real belief they're well placed to deliver that. And I thought that was a noble goal and it was great to see across a wide range of these new industry participants. And of course, we talked to plenty of those 30-somethings in the industry about, well, what are the success factors that, you should expect from, for these businesses to succeed. And on the left-hand side there, it's like a shopping list. A shopping list of things that, an investor would be looking for and judging you on if they want to support you, but also the belief among investors in particular that if you can be well capitalised, that you are respectful of your colleagues across the industry and your customer, that you're setting long-term goals, you do things with simplicity and transparency and so on, then you will absolutely succeed into the future. So that's been a quick run through of the results. The report's chunky, there's plenty of it, and there's lots and lots of the wise words of participants. But it struck us that there were three things that seemed to be highly sustainable going into the future. So I'll just share these as thoughts as before we move into a panel discussion. Look, quality is a word that you hear all the time in this industry. And I love this quote, the cream will rise to the surface with some new froth. There's always going to be noise and froth, and some of that froth will turn out to be cream and some of it will not. Great words of wisdom. And underneath that comment, it is all about quality. Investors are always searching for quality and just won't go for second best. Diversity is something that investors have been calling out for several years now. Diversity is starting to emerge and investors are gathering around. So the chances of that diversity in terms of asset classes and ways of funding, chances of that going away in a hurry, I would imagine were pretty slim. And finally, we've got to end with the consumer. The consumer is changing. The pandemic's probably accelerated the change in terms of forcing people to do everything online at home. At the moment, I love this quote, our hypothesis is in the next 10 years, well, at the moment, 2 or 3% of mortgages are purely direct. In 10 years' time, that could be 20, 25, 30%, who knows? The fact that it'll be bigger, I think, is a given. Let's catch up again in 10 years' time and see whether or not these things have played out. So thanks for listening. We're going to go to the panel now, and I'm going to just stop sharing that screen by clicking that button. And we've got a wonderful panel today, and we've got diversity in the panel, and we've got people with some strong and interesting opinions. So we'll say we've got Neil Murchie. Neil's the Chief Investment Officer for Athena Home Loans. We've got Sarah Sampson, Head of Securitisation, National Australia Bank. Rob Camilleri, everybody knows Rob, Co-founder and Investment Manager, Realm Investment House. And Raj Bhatt, Head of Capital Management at Prosper. Great diversity in terms of the panellists. And you can read their details on the website. And I won't go through them now because you really probably want to hear them answering some questions. So let's get into it. And I'm going to start with Sarah. Sarah, at the beginning of the year, industry participants were using terms like buoyant, gangbusters, good value, those sort of things to describe the health of the industry. What words do you hear people using now?
Good afternoon, everyone. Well, words I hear a lot now are "you're on mute." So hopefully I'm not on mute right now. I see you laughing, so good. Okay. So one of the words that I hear a lot is that supported. I think our industry has been really well supported through the last 6 months. At the start of the COVID crisis, the AOFM very quickly and publicly announced a significant amount of support for our industry, in particular for the non-bank sector, which includes a lot of those non-bank fintechs that you spoke about. And that's through warehouse investment, primary and secondary investment in term deals, and the AOFM forbearance facility. This gave the industry a huge amount of confidence, and I think that's been one of the key drivers that's kept the industry functioning so well over the last 6 months. I'd also say the same about warehouse funders and institutional investors. They've stayed the course and backed the lenders, and that continued support has been critical to keep the industry and the momentum going. Other words, I'd say hardship and recession. I can't really avoid those. This industry is directly and significantly impacted. Most lenders have some level of hardship loans in their portfolio. So, just been dealing with that, and it's obviously just a common theme. I would say it seems to have been incredibly well managed across the board in the securitization industry through the warehouse process and also the term deals, and also through, reporting, and also looking after the underlying borrowers, which is also very important. And I think, we can't avoid, thinking about the potential cliff and what happens when the government support is removed. But I think so far, so good. And the last word I hear a lot about is resilience. I think, to summarise, lenders are still lending, issuers are issuing, and investors are investing. Securitisation's been through a lot over many years. The world has thrown a lot at us. And we always seem to find a path through. We change in different ways, but it is a very important funding tool and it's very relevant. And we just seem to be able to manage, through whatever challenge is thrown our way. So they're the words I hear most of at the moment.
Yeah, and people do a lot of talking. And of course, when we do get to the cliff, let's hope we're like chitty, chitty, bang, bang, and grow some wings and off we go. Raj, we identified 4 big trends this year. There was the increase in participation, the rise of warehouses, growth in non-bank share of RMBS and diversification of asset classes. What do you reckon about those trends? Which do you think will be sustained through the next few years or maybe even 10 years?
I think 10 years is a long time, Gary. I think there's a lot that can happen. Very difficult to pick any one. I think there's a few close for me and from my perspective, and probably a little bit of bias being part of a new asset class, I would say. Look, I think for me, diversification of asset class is something that I've heard for the last 10 to 15 years. And, it's only in the last probably 5 to 10 years that we've seen a lot more of these newer asset classes being originated in a form that can be taken to market. And I think when I look back at the last kind of 5-7 years, when a lot of these fintechs or just non-banks or even newer banks that started to come into play, you need about 3 to 5 years before you can actually start to offer a product into the capital markets, for example. And so when you think about 2013 to 2015 was a period where a lot of fintech startups came through in the Australasian market. And you see a lot of them maturing into the point of going into issuers. We haven't seen that many. There have been a few, and Zip's done one. We were in the process of launching one, but we had COVID, so we're going to come back next year. And then if you think about, I think Sarah's team has recently talked about a green bond as well. So you think about diversification of asset classes is probably the theme that will continue to play as new issuers who have an aspiration to come in, start coming in over the next 5 years. And I think that will continue to play. I don't think it'll take things away from the RMBS or the traditional. It'll just keep adding into that place. So I think that's where I would say very second close for me is the rise of the warehouse. And I think that's really, really something that I've seen where both local and non-local investors are coming into the warehouse level, and particularly in the non-RMBS space. So I think that will be my second close. So hopefully we'll be a lot more issuers in the future.
Yeah, well, certainly hoping that way. And look, the way things are going, as I say, the quality of the people in the industry gives me confidence. I'm sure everybody confidence about that. Neil, what about innovation? When discussing innovation, a few participants talked about a back office digital revolution. Most of the innovation talk was more about the front office sort of stuff and dealing with customers. So in terms of the back office digital revolution, is that ever likely to be a strategic focus, or is that secondary to other priorities?
Yeah, thanks, Gary. I mean, I guess it's absolutely a strategic focus, for us at least, if for no other reason than incumbents are heavily focused on that area themselves and getting better at it. So, for any new entrant worth backing, they need to be focused on how they can improve the back office component of their operation. But I think there's a couple of elements to it. The first one is obviously around cost and efficiency. It's pretty hard to succeed if you're, not making things easier for customers. I saw some research out today that highlighted that time to approval is now the second most important thing borrowers want from their lender after price. Again, that's more important than it even was in last year's surveys. So while I don't think customers expect you to give them a decision on a home loan in 10 or 15 seconds, in fact, some would worry if you did, I think they absolutely expect faster turnaround times than they ever have. So they expect to be kept up to date along the way. And I think a good back office operation is, ideally largely paperless where possible, is a key part of delivering on that. So, we've got a pretty good line of sight on drop off in application funnel and loss conversion due to delays on that sort of thing. So it's absolutely about removing the barrier of inertia for customers. I think COVID will accelerate that. We've already seen, examples, things like Easy Docs and DocuSign and that type of solution have been, implemented probably more quickly than some players would have. In absence of those circumstances, even PEXA adoption has really taken the next level. So I think a paperless mortgage, might not be that far away. The other aspect I think is just worth touching on is just around the credit decision itself. We can't forget which business we're in. While we're pretty focused on the customer, we won't be around for long if we make it so seamless for them that our investors don't end up getting paid back. So, ways to improve things like bank statement collection and analysis on that front. Some fraud protection tools have become increasingly important. We've made some investments there that we think provides greater rigor around process, can really back up your risk management thinking and just enable you to scale up more easily. So that provides transparency to customers as well upfront around their likelihood of getting approval. But it also means I think you can devote the time of your skilled personnel who can, who do look at each and every loan file towards making that assessment as well. So I guess with an Athena hat on, we are looking to compete as a value-led player in the super prime end of the market where margins are tight. So we know we can't fund ourselves at the same rate as a major bank. We absolutely have to compete on origination and servicing costs, and we need to be able to deliver on the promise around credit quality. So in future, it might be a while off, but we'd love to see a world where some of that funding disadvantage reduces or disappears as decision tools for investors become more, I guess, sophisticated as they look at the underlying loan pools. That's clearly a while off yet, but I think, a very slick back office is absolutely part of that as well.
Yeah, it's really interesting, Neil, because I guess there's a natural tendency to talk about growth when you're a new business. And it's fair to say that there were some comments about the sorts of things that you've talked about, but probably not with as much thought and vigor as you've just given us. But most of the talk was actually about scale. And Rob, I'm going to talk to you about scale because there's a lot of new players keen to progress to term market funding. What does a new player have to do to achieve the scale that they're looking for?
It's a good question. I mean, we see a lot of, businesses across the whole spectrum of their life cycle. Some players that just have an idea, and then you've got up and comers like Neil's business where they're building a platform to get to significant scale and then enter the term market. So, and then there's the whole bunch of existing players there which have already achieved that and then become repeat issuers. And I suppose we always look at it as the journey is almost like milestone based. And I suppose when you think about it in terms of those smaller issuers that maybe don't even have a product, they've just got an idea, they don't understand sort of the steps that they need to take. I suppose the first one is they've got to identify a niche in the market or a product. And there are a lot of groups. I mean, probably in the last 2 weeks, I've probably had 10 meetings with, various startups at different stages of that. And they've all got their own unique problems. Some of them actually understand the challenges ahead. So they're probably more advanced than, players that just, they've just got an idea and they're just really trying to navigate the whole, capital markets, securitization world. But, identifying a product is the first step. And then, like with anything, you need a track record. So you've just got to figure out, and this is the chicken and egg thing. How do you actually develop a track record when you don't have funding and you haven't built a capital base yet? So there's sort of that dynamic needs to be solved before you can actually go to the next milestone. It's part of building the business. And look, it's an interesting one because you see some players that actually get there and they've written a small amount of business and they've managed to find some funding and they've built some capital and they're making it work. But you look at them and you look at them in the eyes and you say, well, that's great. You've written 30 or 40 mil. Can you actually write 500 in your product demographic, in your target market? And they're silent because they can never imagine getting that big. But the scale question actually is the important one because they can live in their world with a $30 million book forever and never achieve scale. But that's not what the game that they're in, because they've never thought about how they actually get to 400 or 500 mil. And, when they go knock on Sarah's door, Sarah's thinking about, I want to bank this particular business and I want to take them from 30 to 300 because they're a bankable, scalable, their product is well designed, they've got a track record, and we'll give them that senior funding, which then transforms their business into a larger business. And, I've always described it that, they've figured out a way to write the most tasteless sausage that you can make, if I draw on my Mediterranean heritage. And, there's not enough salt in it, there's not enough fat, there's not enough chili, so they've got to start sprinkling all of that into their business model and their product design so that they can actually, write the next 270 million so they can get to 300. There's no benefit to them going after a part of the market that is so perfect and so pristine that they've got almost no risk in terms of what they're writing, because you just can't write a lot of that mortgages. And you know what? The banks can do it in scale because they've got access to the whole economy. So, you've got to be able to sort of blend, look, the good with the bad is probably a very loose way to describe it, but you've got to put some spice in it. You've got to put some fat in that sausage so that you can get a bit more margin and expand your universe of your product range. And, and I suppose the last thing is, think about the structure. A lot of startups and fintechs haven't actually thought down the line of what type of structure they need. And, you find that they've set up a small managed fund, or they're trying to borrow on their balance sheet. And, and I always say that, you've got to think bigger. You've got to set up the structure today. And, that SPV and that, and the way that assets are held and segregated and services are all really important points of differentiation, because it puts you ahead of the next guy who just doesn't get it. And, and then you're almost match ready to go and talk to a major bank to say, well, look what we've done. We've got our track record. We've got our product. It's very scalable. We've actually built a structure and we're ready to be transformed by going into a bank warehouse facility so that we can go and write the next, $250 million of the product.
Yeah, it's funny, not everybody likes spice as much as you do, Rob. And when it comes to conversations I had with people, a lot of people in the market were talking about, well, it's all very well talking about these new entrants, but RMBS continues to dominate, and the rest of the market is always going to be pretty small. So, Sarah, despite the diversification of asset classes, RMBS does continue to dominate. Do you reckon that is going to continue on into the next 10 years?
Look, I'd love to say it'll be sort of more 50-50, but ultimately I do still think RMBS will be the dominant asset class in terms of, securitization volume by dollar amount issued. But I would expect that to be less so over time. I mean, at the end of the day, mortgage-backed transactions are going to be larger deal sizes because the actual underlying loans themselves, being backed by residential property, are larger than, your personal loan or your very small buy now, pay later type asset. So just through the nature of the underlying, RMBS is likely to stay dominant. But I think if you look at the number of deals issued, I think that potentially can get to 50-50 over a decade from now. if you think about, you know, my somewhat educated guess would be that there's a lot more potential ABS issuers currently being incubated in warehouses relative to, say, new mortgage lenders. So, you know, maybe not all of them make it to market, but if they do, I definitely think there'll be more new ABS issuers than RMBS issuers. And I think they'll be very well supported by the investor community, and we've already seen that through the newer ABS issuers that have come to market. You know, as you spoke about before, investors are crying out for diversity, and there's investors that you know, don't want to buy, you know, your typical RMBS deal, but might buy a green bond from an ABS issuer, for example. So, you know, we'll potentially see diversification of investors coming into the market as well, which is a good thing. I also think from an investor perspective, you know, it's hard for them to justify staying across, you know, the whole SME sector if there's only one deal a year. So again, you know, the more that come, you know, if you build it, they will come type of thing. And I think the more the better. And I also think it will bring diversity of structures, deal structures. So, you know, we've already, you know, got the potential green deal. We've seen master trusts from non-mortgage issuers. And again, those can bring different investors because you can structure things differently. ABS tends to be, you know, shorter. You can do a little bit more with the structures. So, you know, I definitely see it changing. But I think by dollar value, we're probably still going to be an RMBS dominated market.
Yeah, very interesting. And the SME market in particular is very, very interesting. Obviously, at the beginning of the year, different views about what was going on in the SME market. And Raj, you guys have been pretty expert at assessing risk amongst SMEs over several years now. Do you think the fact that we've got a wider range of issuers dealing with the SME market has changed the way the market will assess risk in business lending into the future?
I like the word expert, so I'll take that. Not many people call me that, so we'll take that. So thanks, Gary. I do think it's definitely changed the way people would look at assessing businesses or even asset portfolios that we manage or, you know, our peers manage. And most important, I think Rob mentioned, you know, you need a track record, right? And up until recently, there was no real publicly available data that you could use to measure the performance of businesses. You could, you know, because they were always lent against with some property security, etc. So what really has happened over the last few years is that, you know, the industry where we sit within has focused on writing credit depth, you know, starting to create a track record. It's, you know, we also now have an economic downturn because that's what rating agencies always look for. So we can't get a better one than this. And so with all of that in place, I think what it's doing is it's creating a benchmark. And that benchmark, which will then be used by a wider set of investors, first, obviously the warehouse providers, and then over time, once they get comfortable, you know, the rating agencies, which they've started to get comfortable, and then eventually the fixed income investors who actually have to invest a lot more time to get into deals. So definitely, I think where it's more exciting for people like us is that once you create the track record and once you have the support, you really look at creating innovative new products. And I think there was a question earlier around innovation. I think it was for Neil, and it's way similar to us as well, where, you know, for example, we're using the track record to assess new product opportunities where small businesses can grow, they can run their business, they can pay for their business. And the underlying credit remains the same. So we really, really focused on leveraging that data points, which for us is to create a new product, which eventually needs to be funded by our partners in the warehouses. And eventually with their support, we'll take it to the investors. So that life cycle is somewhere between 3 and 5 years in my world, given our assets are shorter term. So I think definitely what I'll leave this comment with a thought is that over the last few years, we've seen a lot more of the traditional warehouse providers coming forward and supporting newer businesses like us, which is really, really important to actually take these products and then with a fair degree of credibility, go to the market and bring fixed income investors in. And I think that's really going to bring that capital to small businesses in a really different way. So I think definitely the answer is yes, the way you assess risk, the benchmark it's creating, And I do believe over the next 5 years, you will see a lot more activity in this space from my point of view.
Yeah, and certainly we've had quite an interruption to the way things were going from the beginning of the year, but fintechs, SMEs and smaller lenders have benefited from the introduction of the ASF. Neil, I'm just wondering, what do you believe are the longer term focus of the government and the AOFM should be in supporting these businesses?
That's an interesting question, Gary. I'm not sure that's a free hit or a poison chalice you just handed me there, but look, I think it raises the topic of how regulators respond to any crisis, and typically financial system stability has trumped competition concerns, and that was certainly the approach in the GFC. I do think that we've learnt the lessons of fighting the last war to an extent. In many ways, I think Treasury have done a really good job this time around. If you look at the support fund specifically, certainly the quicker announcement around the 15 billion, some rapid implementation early on. Other aspects, I guess we saw the support for unrated warehouses, which certainly helps some of those early stage models. Secondary market trades enabled some recycling of capital, and even just a backstop at, I guess, what I call realistic prices, helped give real money investors some of that confidence to wade back into the market there. I guess the question is really, what do you do in between fighting those wars? How do you prepare for that event that is going to reoccur at some point in the future? So, we engage with AOFM directly and, via our senior lenders on a number of occasions. And, as you'd expect, absolutely professional. They asked all the right questions. There's obviously probity requirements behind everything they're doing. But it was hard, wasn't hard not to feel for them at the time, given, they're a small team, got dozens and dozens of lenders requesting access, different business models, different asset classes. So, I think they did a great job in the circumstances. It was just a challenge around timing and navigating those channels when you're not a household name. I think, we felt that a little bit. We certainly got some of that feedback from other smaller players. I think in contrast, the RBA's term funding facility got announced about the same time. And instantly we saw a proliferation of, fixed rate offerings, which have, literally changed the landscape of industry originations in a matter of months. So, I get that the 25 basis point cost of funds there is more a monetary policy transmission mechanism maybe than a market rate. But I think we are in danger of maybe replicating that competition outcome of the GFC, again, if we're not careful. So I think as an industry, we've evolved with some of those standardized solutions like BCP plans or standby servicing and legal docs to cope with a lot of what if scenarios that are reasonably unlikely, but we haven't really got that solution to the type of market dislocation that seems to be happening, more regularly. So, there's nothing more disruptive to your business than having funding impacted when you've got a pipeline of applications. And, we certainly felt that ourselves back in March. So, I thought the ASF's initiative around forbearance was a terrific idea. And I'd actually love to see how we could extend something like that towards liquidity, potentially with AOFM involvement. We signed up to that scheme. To date, we haven't needed to access it, but back in mid-March, I'm not sure any of us had a clue just how disruptive this would be or how long it would last. So, we absolutely signed up. I do look at it and think, is there a way we can set up something similar, a break glass in type of emergency type solution with maybe some established criteria around limits for access or margin or tenor or whatever else you can incorporate to tie you over through these sorts of dislocations. So, can we pre-vet participants or collateral to accelerate some of those probity processes and ensure that the funding gets out there? Are there structures that the government would be happy to fund, via a pool or warehouse for a defined period? So I think those sort of ideas, if you look at non-bank origination is probably over 20% of mortgage flows at its peak, and even higher in ABS or segments like near prime and specialist. In some ways that's a genuine fifth pillar, which I think if you don't support, generates some unintended consequences in segments of the economy. So I think non-banks and fintechs have driven a lot of innovation over the last 20 years. Any solution that can take out some of that volatility for those players and allow them to see out a storm rather than sort of go into their shell every 5 or 10 years would certainly be worth looking at.
Wonderful comments. And Rom, I think we're going to have to get you to take us into 2030 and sail through everything that's going on at the moment. So what do you reckon, for the next 10 years and as we, will it become more stable? 10 years after the GFC, people were still talking about it, but they felt a lot more confident about the future. Well, what do you think might play out?
Yeah, it's an interesting one. Like I always joke when I'm talking to clients around, the mortgage market and RMBS maybe that, that's the Margot Robbie effect of her sitting in the bathtub drinking champagne, saying that, mortgages are bad and bankers are evil. So you've got to come to, almost like to the defense of the asset class. But you know what, the Australian experience and even the last, 6 months is actually testament to the industry of, how robust a sector that, all of the participants are built. To Neil's point, I remember sitting on the board of the ASF back in 2007, 2008, when, we were floating the idea with Treasury that, you should actually go and buy all of these cheap assets that are getting thrown back to Australia because, the holders just can't funding and they're money good. And we spent a good part of maybe 12 months, in the industry consultation, working groups and a whole bunch of roundtables trying to figure out exactly how this thing would look, feel, work. And then finally the government got there. But you know what, this time around, it took them a matter of days because they'd done it once and they'd seen the benefit of it last time. And you know what, it was a temporary disruption to the market that had nothing to do with solvency. Yes, I know the $15 billion has got the forbearance SPV in there as well. But, we're in a very special time where, it's a government-led recession, which is creating, almost like an out of macro style, arrears profile, which is getting dealt with the whole hardship regime. But you know what, for the better part, when the market was in, and I describe it as liquidity stress in March, everything was just, nowhere. Banks senior couldn't trade, government bonds couldn't trade. And of course, RMBS and ABS weren't in any special lifeboat there. They were in the middle of the ocean as well with all of these other asset classes. But the government came faster than the RBA to go and support this asset class with their support package. And you can see it with the way that the spreads and issuance spreads have been reverted aggressively since April, when the government has stepped in. And look, we've spoken to the ALFM now that, like they're actually saying, well, how good of a portfolio have they actually built? And, they've actually made money for the taxpayer. They could sell that today to the street and it'd be swooped up in its entirety. So I suppose that's an interesting one. So I think, look, there's going to be another crisis. We know that. They're just getting closer together, unfortunately. So, the next government response is going to be as quick and as robust as the one that we've seen in the last 6 months. So I think there's probably not a need to have something built because they already know what they need to do. The $15 billion was, almost replicated everything they learnt in the first time round. So it's going to be really easy to do the next one if need be. And they've figured out how to deal with a solvency issue when it arises as well. Because look, the last thing the government wants is to throw mum and dads, out on the street. And that's not in anybody's interest, including the banks and the non-banks. And I suppose, what can we do better as an industry? Well, the ASF is working on, distilling some of those myths that, the asset class is illiquid. Well, you know what? You look at the last 6 months, government bonds became illiquid. There's degrees of liquidity that come and go. We've just got to focus the price makers that, that in times of heightened volatility, not to forget about RMBS and ABS, because generally they're thinking about their bonus and what they can trade, in velocity to actually make a quick buck. And then sometimes, RMBS puts in that corner that it's all a bit hard. But you know what? It does come, liquidity doesn't ebb and flow. And look, RMBS is as liquid as it's been, forever and a day. And it's probably more liquid today than I've ever remembered it. There's broker-dealer balance sheets putting a lot of money to the market. You can measure that by bid cover ratios. That's sort of our sort of measure in terms of how successful or supportive the industry is. And, the bid cover ratios are really healthy. So that's a really positive sign that investors are, looking through the cycle and saying, the structures are working. They're doing what they're supposed to do. Yeah, we've got this hardship thing that sits in the background, but the government's there to support it. I've got a different view around the cliff in March. I think, you can only ever default once and you only ever go into hardship once. And look, everybody that's defaulted or gone into hardship's already there. So, is there going to be a cliff in March? And look, my opinion is the government's not going to throw people out of the street. If we need to extend that support program, they will. But who's in it and who's using it is already in the price. It's already in the market. So can it get worse than here? Look, I think incidentally, you might find that, as people come off job seeker and maybe JobKeeper, unemployment might ebb and flow, but that underemployment rate and that employment rate are converging to something that's actually more able to be modelled. So, I don't see a cliff event coming in March, and actually, I think you can actually see some really robust forecasts, for the underlying collateral. Like, I think the banks this week, including CBA and Westpac, revised their property forecast higher. So that's a really positive outlook for the sector, which is underpinned by, the collateral of housing. The arrears modelling has actually been better than what most people have forecasted. We've spoken to all of the issuers saying, and they've said, we expected the worst. A lot of their clients panicked in March, and and as Neil said, nobody actually knew what was going to happen. So even if you hadn't lost your job, you took the offer from a bank to actually defer your mortgage because you could. And as soon as it wasn't going to go on your credit file, people who probably didn't need it took it up as well. But now you're seeing people coming off of that in droves. The numbers are actually getting, quite interesting, where, the banks probably might settle at maybe a 1.5% to 2% arrears profile of hardship loans out of their whole mortgage book. That's not a disaster by any state. And the non-banks that haven't, accessed the ALFM program, they're using the structure, they're using their NIM. And these are all things that are fairly positive around the Australian experience in the Australian industry, that, the structures do work. And we've actually got a really good, platform of strong underwriting. We control speculation in the economy, and we haven't actually got a really, another building boom, which actually brings us out of that macro cycle. So we'll deal with these current problems and we'll get through it. And I suppose what we can improve on, and probably on the last point, is two things. More diversity is good. So Raj talking about bringing a new asset class to the market is always a positive thing. And the way that Sarah's spoken about, sort of identifying pools of investors that have different requirements is actually, very, very healthy for the whole industry. And that just creates a bigger sector and more diversity from that point. And I suppose from an asset management point of view, I suppose that, what issuers have got to understand, and what the syndicate players have got to understand, and what investors have also got to understand, is that, the money that actually funds the mortgage industry is actually just mum and dads that sit around the table and invest their super funds and their excess capital into financial products, whether it be through an industry super fund or for a fund like that I manage. It's that mum and dad at the end of the day that are funding the industry. So we've got to understand the whole ecosystem that's involved in designing products or investment products that can support the mortgage industry and support those warehouses and support the public issuance, are all very important parts of that value chain. And sometimes, all the various players forget, how everything's connected, and we're all motivated by different things. But, understanding the ecosystem is actually paramount for a very helpful and successful industry where all participants can thrive.
Good on you, Rob. And we've got just a couple of minutes to go. So I'm going to ask you for just one or two words each before I pass back to Chris Dalton. How are you feeling facing into the decade ahead? So just give me one or two words that describe how you personally are feeling going into the decade ahead. And I'm going to start with you, Sarah.
Bring it on. I'm over this decade.
Yay. Neil?
Oh, we're optimistic on the asset class, on investor interest, and also growth trajectory.
Great. Raj?
Cautiously optimistic.
Nice one. And Rob? Come on, Rob, you're allowed.
Oh, sorry. Yeah, no, look, I'm very optimistic. I think, we'll get through this period, and, the industry's going to thrive, and I think we'll top out, probably our best year ever.
Wonderful. Chris, I won't ask you for your top two words, but I will ask you to finish the session with a few words.
Okay. Thanks very much, Gary. An excellent session. And on behalf of the ASF, I would like to thank Gary for his hard work in doing the research this year. It was done in two parts over two different, very, very different periods. And also our thanks to Perpetual in supporting research into our market. I'd also like to thank today's panelists, Neil, Sarah, Raj, and Rob. Provided wonderful insights into what's been happening and what we could expect going forward. And I'd also like to take the opportunity whilst we're together to inform those that are wondering about our conference this year. Typically, we hold the ASF conference in November. We're not holding it in person this year, but we're putting together a 3-day symposium, which will be delivered virtually. And we're working together with Kanga News, who have helped us and supported us today with this seminar. And details of that will be shortly available from our website. But please look out for that program. That's November 17 through 19 this year. And finally, I would just like to thank you for joining us today. It's been an interesting session. The recording will be available for either your replay or to pass on to your colleagues. That will be on the ASF website from tomorrow. So thanks everybody for joining.